Welcome back to lesson 8 of the future series. In this lesson, we're going to cover two of the most important concepts in future trading, margin and position sizing. I know I've mentioned about margin, leverage, and all that stuff in a previous lesson, but in this lesson, we're going to look mainly into margin and we're going to kind of go more into it. There will be a few things that are repetitive, like the two types of margins. And we're also going to talk about leverage for like one slide, but it's mainly going to be margin. And yeah, the goal of the lesson is to teach you how future margins work, how to calculate your risk, and how to size trades with discipline. And whether you're trading full size contract or micros, discipline is very, very important. So this lesson is going to kind of help you grasp some knowledge about that. So in futures trading, margin doesn't mean what it means in stocks, right? It's not borrowing from a broker or taking on debt. In futures, margin is a performance bond. It is the money required to open and maintain a position. So there are two kinds of margins. There is an initial margin and a maintenance margin. So the initial margin is the amount you must have in your account to open the trade. The maintenance margin is a little different. It is the minimum you need to keep the trade open. So if your count drops below that, you get a margin call. We're not going to talk about margin calls. I already talked about this in another video. So the exchange, there is something called the SME group. They set this margin requirement. On top of that, your broker may ask you for more depending on your account type or overnight exposure. So the SME group creates like a margin requirement. And then the brokers who are allowing you to trade these stocks, well, sorry, not stocks, futures, allowing you to trade these futures, they will put an additional type of money on that margin, depending on what type of futures contract it is, and so on. So for example, to trade one ES contract, you might need around 11,000 in initial margin. But that contract gives you control over 200,000 of market exposure, which is leverage. We talked about this already. So this is what makes futures very powerful, but also risky, right? Small moves can create big gains or losses because you're controlling 10 to 20 times your margin deposit. And so understanding this margin is so important because it's like a gateway to leverage. And leverage is what makes futures both profitable and dangerous. But we're going to talk mostly about margins. So in futures trading, margin isn't just a fixed number. It depends on what you're trading. Most brokers offer something called day trading margin, which is like a reduced margin requirement during regular trading hours. And these can be often as low as, let's say, 5 to 20% of the full exchange margin. So for instance, let's say the full margin for the ES contract is 11,000, like we mentioned. The day trading margin could be as low as $500 to $1,000 per contract. And you may wonder, well, why is it so low? Well, the reason it's so low is because brokers assume you're in and out during the day. And market risk is lower when you're not holding positions overnight because there is so much volume in the market. But if you plan to hold past the broker's cutoff time, which is usually between 4:45 to 5 p.m. Eastern time, which is after the stock market is closed, they'll require you to post the full overnight margin. And so if you don't have it, the broker may actually forcefully close your position before the session ends. This is especially important because with small accounts, you may be able to day trade one or two contracts, but not hold them overnight unless you have enough margin. So you should always know what is your broker's cutoff time, what your day margin is compared to your overnight margin levels are, and whether your strategy requires overnight exposure. And kind of like the last thing you want to have like happen, obviously, is you don't want to be in a position where you're in a trade and it becomes an overnight margin. So the overnight margins are active because it's past 5 p.m. let's say, and your position gets closed and you lose money, let's say. And that's all because you misunderstood a margin rule that your broker gave you or whatever value they gave you. So what comes after margin is the next question. Well, how many contracts should you really trade? Now, this comes down to position sizing, and it starts with one main rule. And it is trade based on risk, not based on how you feel like trading. And like there's a simple rule of thumb where you want to risk 1 maybe 2% max of your account per trade, and never more than that, especially in futures where things move fast. Because if you're trading let's say 10% of your account on one trade, if one thing goes wrong, you could automatically get that margin call and lose almost all of your account. So it's important to always have small trades, like 1 to 2%. I know people go up all the way to 5%, which is not bad, but I don't suggest going anything above 5%. So here's like a quick scenario. So you got 5,000, depending on your percentage. Let's say we're trying to trade 3%. So if you're at 50,000 in your account, your trade should not be more than $1,500. So size, you want to first pick your stop loss in points. Then after you get the stop loss, let's say 5 points, 10 points, you take that and you multiply that by the dollar value per point. And then you divide your allowed risk by that number. So for instance, let's say you're trading the ES and your stop loss is 5 points. The ES moves in 0.25 ticks, quarter ticks, so 4 ticks is 1 point, which each tick with one contract is $12.50. So 1 point is $50. 50 times 5 points is 20 ticks, or $250 per contract. So if you only want to risk 500 total, you can do up to 2 contracts, no more, because that is 5 points. And if you're using a small account, an even smaller account, you could use the micro futures, which are the MES, which are $5 per point or $2 per tick. And so that same 5-point stop would only risk roughly $25 on the MES or $50 on the MNQ. So it really depends on how much capital you have in the account, how much percent you're trying to risk, and your stop loss. With all that, you can do this little calculation and see how many contracts you are willing to risk. And so this kind of small formula kind of makes it easier to control risk while still trading real contracts. The point is to never base position size on margin alone, because margin tells you what you can trade and risk tells you what you should trade, right? Margin is kind of just like a rule of thumb there. Everybody has that margin, but everybody also has different risk. So you don't want to depend your trade off margin. You want to call it off risk. Kind of talking about leverage for a split second. One of the biggest reasons traders are drawn to future is because of the leverage, but it's also the biggest reason accounts get blown up. Leverage means you can control a large amount of market exposure with a relatively small amount of capital. For instance, one ES contract is around $200,000 of market value, yet your margin requirement might only be $1,000 to $12,000 depending on your broker and timing. That is 10 to 200 times the leverage. That means every point of movement, every one tick represents real dollar value. So 1 point on the ES is 50, 5 points is 250, 10 points is 500. Now, I want you to imagine getting caught in a fast-paced move against you. It's not hard to lose several $100s in seconds if your size is too big. This is why proper position sizing, a clear stop loss, and risk-based planning are non-negotiable. You need to do this. Leverage can be your best friend, but also your worst enemy. So use it strategically, not emotionally. You want leverage to be your friend. You don't want it to go against you. Many pros, I know like many pros that have lots of capital, but they only trade 1 or 2 contracts at a time. And it's not because they don't have more capital, but it's because they'll respect the power of the product. You know, with 1 or 2 contracts, you can make a lot of money. Obviously, you need to be able to spot this trade, but you can still make a lot of money. You shouldn't be risking your whole account with like 10 contracts just to catch a couple points and make a few bucks. But you're better off risking less contracts and being better trader and catching those big trades. And so if you're consistent and controlled with leverage, you'll survive the volatility and build an edge. And if you over leverage, well, and like kind of wing it, then the market will teach you like really fastly and it will wipe your position out easily. Now, kind of to like finish this off, I want to mention 5 mistakes. So the first biggest mistake is sizing based on margin. We kind of talked about this. Just because your broker lets you trade 5 contracts with like $2,000, it doesn't mean you should. Margin should kind of like shows you what you can trade, but not what you should. Instead, size your contracts based off dollar risk tied to your stop loss. We kind of already talked about this. Another big mistake is ignoring your stop size. You need to ask, how much will I lose if I'm wrong? If your stop is 6 points on the ES with 1 contract, well, that's only $300. And that adds up fast if you're trading too big. So you should always make sure to realize what your stop is. Third is holding trades overnight without full margin. Many traders forget their broker's cutoff time and get hit with forced liquidation or margin calls because they held a position with day margin past the close. So know your broker's cutoff time. Another mistake is over leveraging small accounts. Now, what this means is new traders often try to trade full size contracts with $1,000 to $2,000. And so what happens is one fast move against them wipes out half or even all of their account. And so the lesson in this is you should use micro futures because they trade smaller and survive longer, especially when you have a smaller account. And kind of the last mistake is not adjusting size for volatility. One high volatility day, which could come from stuff like FOMC, CPI, earnings reports, stuff like that. Markets can swing 10 to 20 points in just a minute, or well, I guess minutes. So if you're trading your normal size, that kind of move can blow your stop and destroy your risk model. Yes, it could also make you a lot of money, but you kind of have to understand volatility in the market and things that can impact the volatility. So what can you do to fix this? Well, you have to build a process. You have to size based on your account and stop, not the margin allowed. You need to use micros to scale safely depending on the capital within the account, and always know your risk before clicking anything. Trading with leverage is a privilege. You got to understand that. And in futures, it requires respect and discipline. Without discipline and a strong mental health, you will not be able to survive the market. Because what would happen is you might have 3 amazing days. You make 1,000 on Monday, 1,000 on Tuesday, 1,000 on Wednesday. And what will happen is without discipline and strong mentality, you could go down $500. And what happens is your brain is going to say, well, come on, I made 1,000 3 days in a row. I could do it again. And you're going to keep entering positions that you're not sure about. And what's going to end up happening is you're going to end up wiping your account. This has happened to me before. I've had days where I had 5-6 day streak. And one day I lost $5,600 just because of my discipline. So you need to be able to control it so you can stay in the game. And obviously, if not, then your game is over. So I hope this video kind of helped you. The last lesson is going to come out tomorrow. Forgot what it's called. But yeah, I hope you enjoyed this video. Thank you so much for watching.